and welcome. A new fund house has just entered the scene. Capital Mind Mutual Fund and its first offering, a Flexi Cap fund, is now open for subscription. Joining us today is Deepak Shenoy. He's founder of Capital Mind Mutual Fund, and he'll walk us through what sets this launch apart and what he's building for Indian investors. Welcome, Deepak.
Thanks so much, Ruchira. Happy to be here.
Great to have you here. Now, let's begin with the big shift. Why did Capital Mind decide to move from PMS to a full-fledged mutual fund? What gap or opportunities did you see there?
So two things, Ruchira. I think firstly, we are as a PMS, we have been able to talk primarily to HNIs because they have to invest a minimum of 50 lakh rupees.
Right.
Our strategies are, of course, built like in the PMS were built like a mutual fund itself. We invest in stocks, we invest in other mutual funds actually, and that is also part of the portfolios. And the idea was to help people build wealth for a longer term goal. And we didn't charge a performance fee. That means no profit sharing, which is common in the PMS industry. So even mutual funds, they don't charge a performance fee. They only charge a management fee. That's how we kind of structured the PMS itself. But we realized over time that customers have varying needs. Sometimes you cannot solve that in a PMS. They have less than 50 lakh rupees. Can't solve that in the PMS. Cannot invest in certain types of assets, which include perhaps gold, international investing. Debt itself is not very easily available to the smaller investor, even in a PMS, because you can only invest it in a pool. You need 5 crores, 10 crores, 25 crores to be able to invest in debt meaningfully. So that kind of gave us the thought that we can better serve investors, a larger base of investors. With a mutual fund, you can invest in more asset classes. You can invest more efficiently in the same asset class. You have a little bit of a tax advantage in the mutual fund because the mutual fund does not have to pay taxes until you exit. You don't have to pay any taxes as an investor. So these are the things that kind of prompted us to build a mutual fund approach that gives more efficiency to investors, more asset classes, and can serve a larger investor base also.
All right. So, can you share with us how will your investing philosophy carry over into the mutual fund space?
So some of the beliefs that we have strongly, that we believe in strongly, continue to be a part of Capital Mind core philosophy, although the AMC is a separate business from the PMS. What we've always believed is that that we try to look at ranges, probabilities, rather than trying to believe in exactness. So we look at a lot of data, but we don't try to predict accurately what will happen. We prefer to respond to market realities as they change. And over a time, trying to say that, oh, this company is worth this much, or this is the kind of market change that will happen over the next 5 years. We are more associated with broad ranges and possibilities and more focused on protecting the downside than trying to specifically target a range. The second one is, or target a certain price or something like that. Second one is that market perception is very, very important. If the portfolios that you have may have great stocks, but if they're not considered to be great by perception in terms of whether the P ratio is an indication of sentiment, or whether anything else in the market price itself is determined by either common trends or governance frameworks. You want to be cognizant of that. So you want the market perception to be, and the market, effectively the market price also, to be what determines your long-term goals. And then lastly, of course, the idea is that nothing stays forever. So there are very, very few forever investments, which means that you cannot fall in love with the companies that you own. You have to be cognizant that times will change, trends will change. Good companies will remain good, but other companies may become better. Good companies may not be so good anymore, whether it is Kodak, which was owning the photography universe, and today I think the phones have it. So Kodak is nowhere in the picture. It was unable to evolve during that process. And similarly, a lot of companies which were very, very great in the early parts of perhaps 20, 30, 40 years ago to where we are now. So whether it is a commonly well-known brand or an industrial company, sometimes things change and you have to change alongside. So these are the core philosophies. Primarily, we believe in using data and a quantitative approach to a lot of our investing. So we like our opinions to be validated by data. We like our data to drive a lot of decision making so that we are able to make decisions using less of subjective and more of objective frameworks. And lastly, that market volumes are very important feedback for us in our investing process.
Okay, let's delve deeper into this. So, if you could further explain what are your core investment beliefs, as in what principles shape how you think about risk, return, long term compounding, all of that?
Yeah, I think one of the things, Ruchira, is that long-term compounding, long-term investing always needs a multi-year approach. So the common approach of using just 1 year returns to gauge investments is difficult. So as an NFO, also I come to you with humility because I don't have 1 year or 3 year performance to show to you right now. But I also have this belief that in the long term, a lot of strategies have to work through market cycles. We have seen this in the PMS, we have seen this in the past, that we have to test whatever we have done or even go through whatever we have done over a bull run, a bear run, a time of sideways movements, and so on. So that everything that we do as a mutual fund brand will actually have to go through many of these cycles before we're able to demonstrate our performance. Our longer term goal is that when we have a quantitative framework, we also have the tools or the ability to test historically as well. That
Hmm.
means if I were to say I want to buy stocks that are on an uptrend or that are highly profitable, what is highly profitable today may not have been highly profitable 5 years ago. So I cannot assume that I would have bought it 5 years ago and then held it on till now, even though it has given great returns. So we've built technological frameworks that allow us to test point in time what portfolios would we have built in the past,
Mhm.
remove a common set of biases that happen in such back tests, which is survivorship bias. So a company may have died, but may have had the right quantitative attributes, so that you
Hmm.
could have actually bought them 5 years ago. And you should assume that you would have bought them and lost your money in those companies as well. So you also don't want the winners, but you want the losers to appear in your tests, so that
Hmm.
you're able to get more correct frameworks. And then secondly, run your theoretical test alongside your reality, so that you know that your actual investing is not divorced from the reality of the markets itself, and that you're getting similar returns on both ends. So the idea of a deep quantitative layers of testing gives us the ability to say that our strategies, had they been run in the past, could have given us some kind of an indication of what kind of numbers and returns we're talking about. The Flexi Cap Fund, which is our first fund, is a culmination of a lot of research of that, a culmination of what the thought process of various kinds of factor investing itself. The concept of factor investing, just to give you an example, is if you look at any sport, let's say a Formula One race, people know the names of the lead or the most popular drivers. And if you ask them to select the kind of team or driver that they would go pretty much based on reputation, saying, oh, this person is top ranked or this person is more likely to win. Whereas if you change the approach to the sport that says, on this track, actually, what I would like is someone who is very good with aggressive overtaking. And because there's a possibility of rain, I want a person who can handle the rain parts well. Instead of looking at the drivers themselves, we map each driver into their attributes and how do they score in terms of aggressive overtaking, how do they score in rain, how do they score in different types of weather. So there's a score allotted to each driver. And whatever attributes that you want in a particular circuit, you actually choose the drivers with the right attributes. So you focus on the attributes rather than on the drivers. Sometimes you may make non-intuitive choices simply because the attributes of the most popular drivers may not actually match what type of drivers you need. Probably most well embodied in the movie or the book called Moneyball, where they selected basketball teams using that. using these factors. Now it's more commonplace over there. Similarly, in investing, you have a way to say a stock is value, has a certain amount of value. It is ranked on a value universe by saying it's cheap compared to perhaps its peers or something like that. And then you have something called quality, where the ROE or the return on equity ratios have been very high for the last few years. Similar and more popular with us at least is a factor called momentum, which is stocks that have demonstrated that their prices have gone up meaningfully on an uptrend over the last year or last 2 years or so. This attributes, we've actually mapped a lot of these factors, and we've chosen factors that are more favorable in certain times, and we change into other factors when certain other factors, so our core factors are not favorable in market trends. So the idea is to be able to test this, to be able to use a quantitative framework rather than say, well, I like this company because I know the promoter and so on. By the
Hmm.
way, all kinds of market approaches win. It's not just what we are using, but what we found that there are multiple ways to make good returns in the long term in the markets. Our long term approach is to find the right ways and perhaps go down each of those ways in different in the with the kind of quality and testing that we're doing for everything else that we use as well.
Right. So I'll talk in more detail about the FlexiCap fund. But before that, beyond this launch, how do you see Capital Mind Mutual Fund evolving? Is the goal to stay a high conviction boutique or scale for broader adoption? What is it?
So I think our broader concept is to help investors. We call the tagline "Win at Life." So the idea is to allow investors a platform that allows them to invest for their long-term wealth, to change the way that they're thinking about wealth in terms of meeting their long-term goals, to give them the ability to think about what they should do with their money rather than just accumulate a lot of money, and to also at the same time, because there will be different people with different needs, we will
Hmm.
need short-term products such as debt or liquid or arbitrage products. We will need medium-term debt products. We will need balanced products for people who are unable to take the volatility of equity as a whole and need something that balances the risk out. So we will have the universe of products which will actually meet investors' needs on in their quest to win at life. Uh, I think the overall framework will involve equity per se, but will also involve hybrids and will also involve debt. The
Okay.
core philosophy here is to reduce the pain of investors in the intimidation that the financial world generally causes by using jargon that is perhaps not easily understandable, to make it simple enough for investors. So we are looking broad based. We're not going to be boutique.
Okay.
We will evolve as time goes. So I won't start off with 500 funds for sure, but we do want to have enough funds to meet a bunch of investors' needs. And even looking at ourselves, what would we invest in? That is the kind of products we have, and we are going to be invested in our own products. I am personally invested in going to be personally invested in the products that we have, not just by regulation, but also by choice.
Okay, great. So now let's get into the fund itself. If you could share with us, what is the core idea behind your FlexiCap fund? What are you hoping to deliver for investors? You did share it's going to be a quantitative framework. A lot of research has gone into it, then factor investing, but what is the core idea behind it, and what is it that you're hoping to deliver?
Super. So I'll tell you about the Capital Mind FlexiCap Fund. Now, first of all, of course, all the risk disclosures apply. So mutual funds are subject to market risk. So
Yeah.
read all scheme-related documents carefully. The FlexiCap fund itself is based, it's a flexible market cap fund. That means we can buy small, mid, and large cap in any proportion that we choose.
Right.
We've chosen to use an approach that is quantitative in nature, uses factors. We tested all the factors. The
Mhm.
factor that seems to be the most performing in the universe that we have selected, about 20 years, 18 years of data, is momentum. So momentum is one of the most strongly performing. But we've noticed that in general, momentum performs well in uptrends. The market is in uptrending most of the time, maybe more than 50% of the time, it remains on an uptrend. But there are enough times when it goes into a no trend zone and then it goes into a downtrend zone. So a layer above this is for us to determine what regime the market is in, uptrend, no trend, or downtrend. That is also something we have been able to define in a more quantitative way using our proprietary technology and indicators that gives us the idea of market breadth, volumes, and a bunch of other things. That tells us whether the market is currently in an uptrend, currently in a no trend, or currently in a downtrend. In an uptrend, we will be primarily in a momentum factor. In a no trend, we will have a combination of some of the other factors. The sum of the other factors will also be chosen based on the performance of those factors during the immediate past as well. And also a combination of whether it is size, quality, value, or any of the other attributes. We will choose those, we choose those factors based on market dynamics at the time. So it's not any single factor. So we're not switching from momentum to value, momentum to quality. It will be the second the factor in a no trend is chosen during the no trend times itself. But in a downtrend, and downtrend happens when there's a significant market dip, is that we hedge our positions. So we take hedged exposure to the markets. So we'll still be 65% equity, but part of the equity will be hedged, and they will be, of course, will be 65%. I mean, we have to be minimum 65% equity, but a part of that will be hedged during downtimes as well. So it's a flexible approach. So we don't restrict ourselves to large caps and mid caps or things like that. Much of our cap positions will probably be determined by our size. As we grow higher and higher in size, the chances that we will have a lot more positions in large caps will probably increase simply because the fund automatically selects its stocks based on the liquidity available. Since the positions may change based on momentum of the market, maybe based on the trend of the market, there will be a significantly high churn in this portfolio. So it will not be a buy and hold. There will be positions changing regularly. So we should expect higher churn in this portfolio in the FlexiCap fund.
All right. So when you're building the portfolio, what are the must-haves that you look for in a stock beyond valuation and market cap? What are the factors that help you decide that these are the stocks that should be in your portfolio?
There are a few, in the investing process involves filtering stocks at different layers. A lot of times we filter our stocks out because they don't trade enough. There's not enough volume in those stocks. So we will not get into those stocks in the first place. When I say enough, it is respect to our AUM itself. So since we will have, I think the idea is between 25 and 60 or 60 plus stocks that we could have in the portfolio. The number of stocks will also be determined by the number of qualifying stocks based on a lot of input criteria. So the momentum criteria, the factors that choose the stock are price momentum with some kind of volume backing. The value criteria is based on the price to earnings ratio, the lower the better, of course, here, which is more prevalent in the value universe. And some of the other factors, quality, for instance, is either return on capital employed or return on equity with a low debt component. Profitability is based on the amount of profit you're able to generate on the total amount of assets you have. So a lot of these quantitative metrics form a core of the selection process of the portfolio and the maintenance and the position size as well. So you will find that a lot of positions will be built based on the ability for them to meet each of the criteria that they're on. So if you're choosing momentum, it will be the amount of momentum in the stock. Of course, there are greater layers on top. The fund manager has the ability to remove stocks from the universe, which he feels is not compatible on a corporate governance level, or if there's anything happening over there that we feel that needs us to avoid those stocks. So the primary reason for us to look at the corporate governance and the structures from a risk perspective will remove or eliminate stocks which are deemed too risky on the downside, basically because we feel something else is happening. And of course, there may be corporate actions that are happening that may require us to not have or have a position, such as a merger, an acquisition, or something like that. So that would be another, a layer on top. That's the fund managers. We keep the discretion to a minimum, but that discretion is required to be able to say, well, we don't want to get into the wrong kind of stocks.
Right. So you did say that, like you said, key benefit is flexibility and positions will be decided by size. So how do you plan to shift between large, mid, and small cap stocks as the market evolves?
The algorithm itself will have a bias. It doesn't bias itself towards any market cap, but
Hmm.
it biases itself towards the factor involved.
Okay.
Sometimes there are more mid and small cap stocks that qualify in our criteria. Sometimes it's more large cap stocks. So the variation will be based on market conditions at that time. There will be almost always a representation of each market cap for the time
Right.
being. Uh, and a lot of it depends on the amount of assets we have in the FlexiCap fund. So as it grows bigger, the ability for us to take a lot of really small micro cap positions becomes lesser. But remember now, a small cap is actually right at this time. This is July 2025. At this time, a small cap, I think, is 33 or 34,000 crores or less will become a small cap. 34
Mhm.
to nearly 100,000 crores is a mid cap, and only above 100,000 crores is a large cap. So the universe is actually trading a lot more today than it used to be. So that means a lot of companies can qualify. Even a 30,000 crore company today is a small cap company. So
Hmm.
therefore, a 30,000 crore, just to give an example, about 8 years ago, such a company would have been called a large cap. So
Yeah.
today it's a small cap company. So we can expect that a lot of companies will meet this criteria, which will be in all market caps.
Right. Okay. So, Deepak, you're launching in a dynamic market and a crowded category. So, what will differentiate Capital Mind's FlexiCap strategy from the 40 odd funds already out there?
Yes, I think every fund has some layer of uniqueness. So whether it is the fund manager's ability or process to get to it, our process being primarily quantitative may be slightly different from some of the others. And the quantitative process primarily drives stock selection versus using a more traditional, I meet the management, I will get the
Mm.
conviction into the company, and then I will buy them based on certain criteria. I think by and large, what we have found is a lot of momentum based positions, a lot of value based positions, even when you look at it from a quantitative basis, may actually meet a lot of the stocks that other funds may have taken on a subjective basis also. It's just that it's probably coincidence that they match, but we tend to find that our approach gives us a little bit less dependence on uh, fund manager excellence in that sense, or even the ability to meet customers, because you have 700 odd companies in the market universe, and that you can't meet all of them at any given point in time. The quantitative nature allows us to identify companies early in the process and build positions in them when they are showing the right kind of attributes. So that is a slightly different approach to the marketing, to the market itself, and to the investment approach. The process, of course, requires us to test a lot.
Yeah.
So it doesn't matter that we like a company, the value has to come from the data itself, that the data shows us. Sometimes it's too early to take a position into a company simply because it doesn't have enough volume, it's going in upper circuits. We won't even touch such a company perhaps in the flexi cap fund. But when it stabilizes, so often we get in a lot later than many companies will many other people will look and say, oh, it was already uptrending. Why didn't you get in? Well, the numbers didn't meet or didn't show us a yes buy until this point, and only then we can take it. So we've seen this in the past. So we've seen in the past data that, oh, we would have bought a stock, but it wouldn't have bought it to the absolute bottom for sure. And many times you needed that uptrend to buy it, especially if you're in a trending market, you need momentum to actually establish itself before we can purchase a stock. In other criteria like value and quality or growth or profitability, sometimes the profits show in the balance sheets a few years after the management has actually said they will do it. So we'll take the management's word, but we'll wait till the numbers show up on the balance sheets and the profit and loss statements before our quantitative algorithm will identify them as they're a go ahead for us. So that is a small differentiator. Of course, the larger differences will come in investor perception of the stocks that we choose. That means the market sentiment itself. We also track that very closely and believe that price is an important feedback criteria for us to build more conviction in the stock itself.
Right. So who is the ideal investor, or who is this fund ideal for? What would you say to that?
Yes. So I think two layers here. First, I think you have to have a long-term mindset.
Mhm.
Something of our strategy itself has tested. We were not going to be able to beat even the benchmarks or even other funds here on a 1 year basis for sure. That is not, it's very, very difficult for anybody to be able to say we will beat something consistently on a 1 year basis. But as we get longer and longer in horizon, the ability in the past to have the probability of having beaten in the past in our back tests has increased quite substantially. So the 3 year or more horizon investor is the one that would be useful for this. Someone who have the ability to take a very high amount of risk, because we're investing into equities, and equities can go anywhere at any time. So the risk is the maximum possible risk here. The third is a person who does not have or does not perhaps already have a quantitative based approach in their portfolio, and that can fill that void in that kind of a portfolio in a flexi cap approach. So we would kind of fit very well for those investors. And lastly, I think the idea is someone who has the ability to regularly invest rather than point in time, because sometimes entry points can be very, very deterministic of your long-term returns. So you got in at the wrong time and you looked at it 3 years later. So it's better for a person who has the ability to invest over a period of time rather than all at once. Of course, it's a lump sum investment. Many people do it to test, and that's not a problem at all. But I think the power of any long-term strategy is to demonstrate itself through ups and downs. And therefore, an investor also tends to get better returns if they've invested over a period of time rather than concentrated at one point.
All right. So one final question. As your mutual fund journey begins, how do you see the brand and fund house shaping up over the next 3 to 5 years?
Oh, well, we're in the early days of it, Ruchira. I think it would be difficult for me to make estimates, but we've got good plans. We want to build our fund house over 3 years into all the categories that we talked about: equity, debt, and hybrid. We will have a limited number of funds, but we will actually serve investor purpose meaningfully through these investment funds that we're creating. We also want to use all our resources to educate investors as much as we can on the various aspects of investing in mutual funds and building more. And you will find us a lot using digital techniques, whether it is social media, whether it is video, whether it is something like that, to be able to give our investor education out to people. And we've done this as a Capital Mind brand even before this a lot, whether it is understanding macroeconomic concepts, whether it's understanding equity investing concepts, debt, the way mutual funds operate, the way the Indian budget affects the economy, and all of these things in a more meaningful, heart-to-heart, person-to-person way. We've always been, focused on reducing jargon and making people understand in the most meaningful way possible. So I think that is something that's a strength that we have to kind of push forward as well. So winning at life actually means not having to worry about your money all the time.
Right.
I think that is also important, because it's more important that you focus on what you want to do with your money. and with your savings, rather than kind of having to. And also, winning at life means winning at life every point of the way, right? Not just I don't want to only be wealthy when I'm 60 and 65. I have to enjoy my life throughout my journey. So do whatever we can as a brand to assuage investor concerns at all points in time, so that they don't have to worry about their investments. As long as they're in for the long term, I think we can meet their needs, but they have to be constantly energized with the fact that the long term thought process consistently works. Now, whether it is with us or with anywhere else, I think the idea is the investor's mind should be put at rest in terms of, that their investments are being done in a meaningfully useful manner for them. But also that they should that they should live their life better through the investing process. So I think as a brand, as a mutual fund house, we will be quantitative in nature as much as we can. We'll use data and technology to solve this, but we'll also use digital to use our to spread our views, our education, and the information that we can gather that helps people decide and eases their mind off investments going forward.
All right, great. So with that, time for us to wrap up this chat. Thank you, Deepak, for sharing your vision for the fund house as well as for this NFO. Thank you.
Thank you so much, Rajita.
Thanks. Well, that was Deepak Shenoy on launching Capital Mind Mutual Fund and how their FlexiCap fund plans to stand out. That's all we have for you today. Thank you for watching. Keep watching this space for more information. Thanks.